Well,
hi.
We're here.
Here we are.
You had kind of a crazy morning, huh?
It's been a week.
Oh, man.
I spent the morning getting my son's arm casted, 6.5. He fell at parkour. He was swinging on a bar and
6.5. That's about right.
Hand. I mean, yeah, every kid's got to have a cast at some point, right? I'm just glad it's not the middle of summer.
Yeah.
And he was a champ about it.
Was he?
Yeah. Oh, totally.
He looks
Super
like
brave.
he's like really, yeah.
Yeah.
He seems very stoic.
He is. He's like Marcus Aurelius.
Wow. Very cool. Very cool.
Yeah. So,
very
and
cool.
we had some good CPI data.
Yeah.
Love that.
If you're watching this, in the future, today's the day when the CPI numbers came out. It's November, 10th today.
Uh-huh.
And finally, we're starting to see a little bit of light at the end of the tunnel where CPI is calming down.
Yes.
It went down to like 7.7%.
And if you're watching the markets today.
Yeah. How about that? Up 1,000 points. I think the S&P at one point was up more than 5% today.
Yeah. Yeah.
And, you have these stories about, you don't want to miss the best days, right? Well, there you go. Yeah.
You missed it.
Yeah.
Sorry.
The only reason you should be missing a day like this is if you're dollar cost averaging into the market. That's the only way. Otherwise, you should not be missing these. So welcome to A Place of Possibility. We are happy to have you here. I am Richard Del Monte.
I'm Angela Wright.
Thank you for being here with us. What are we talking about today, boss?
Today, we're talking about initial public offerings,
Ooh,
IPOs.
What a great topic.
Very fancy.
Oh, yeah.
So, are they the road to riches or the path to poverty?
That depends.
So, we hope to just give you a clear-eyed look at what an IPO is, who may or may not buy them, what happens once they go public, and just kind of get you more educated about the topic. Yeah.
And we've all heard stories about, people who got in on the ground floor of companies that became, fabulously successful, like, I don't know, Amazon, Netflix, Apple.
Isn't that
Tesla.
The American dream? I got in on the ground floor.
Yeah, I did nothing else right in my whole life, but I got stock at the IPO right on this one company. And like, Forrest Gump. Remember Forrest Gump? He got into Apple, became a gazillionaire. That's all he ever did, So, so many other companies like that. But the ugly truth is that, and which we don't really talk about, but the soft underbelly is that for every Amazon out there, which has, hit it out of the park, there's another one like DWAC, which is Digital World Acquisition Corp, which is Donald Trump's media outlet. That is down 76% so far since it went IPO. And Beyond Meat, some of us even like that stuff, right?
I eat it. Sure.
Eat it. Yeah. Well, sorry, it's down 82% from the IPO price. And Allbirds, there's like fabulous shoes people love, 2 years ago. Yeah. Stock's down 88% since the IPO. Oof. So not a guarantee, right?
Yeah.
Of success at all.
Yeah. I mean, they never are, but I think at IPOs, the risk factor goes up significantly. Yeah, and we'll talk about why.
We're going to talk about why. Right?
Okay. So, but let's start with the basics. If somebody doesn't know what the heck an IPO is or how they work. So, IPO stands for initial public offering. It's when a privately owned company decides to become publicly owned through an offering of stock to the public. Now, why would a great private company do this? Why go through all the rigmarole? Well, often it's because they need to raise capital for one reason or another. They need to grow, right? You've gotten, like, let's say you've got a little baking company in your kitchen and you've got,
Mrs. Fields, like,
sure. Yeah. Okay. And you want to, you're hitting it out of the park and you want to expand, but you don't personally have the money to go buy a giant warehouse, employ all the people, get the machines to mass produce your cookies. Yeah. One way that you could do this is through borrowing, of course, right?
Yeah, 10% today.
Well, exactly.
Right? Yeah.
So in an environment like today, it's really hard for companies to expand through borrowing because interest rates are through the roof. You just can't get as much money. You've also got inflationary environment. The things they're buying are costing more. Then you have to borrow more. Then you pay more interest. You can see how the dominoes just fall. And then, maybe a potential economic slowdown would, people stop buying cookies all of a sudden because their grocery bill is too high. So by offering stock to the public, it's a way that they can grow the company without having to borrow. Another reason you might sell shares to the public, say that 3 times fast.
Sally sells shares to the seashore. Yeah, right.
Sally's shares to the seashore is a liquidity event. Like maybe we're buying out the initial founders. Perhaps they've grown the company and it's been fabulous and they're ready to retire, but there's no like internal person to buy it. you sell it off to the public, or maybe, you know, some of the initial officers or executives want to sell their shares. This is known as a liquidity event. Right.
This is what has made the Bay Area the haven of technology that it's grown to become.
Yeah, so if you've got friends who are like working in tech and they got their options and then they were bought out, this is what's happening here is they have all these stock options. The company went public. They got a big old payday on that.
Liquidity event.
Yes.
Yeah, that's right. Yeah. Okay. So that's right. So assuming the company does want to go sell shares, what ends up happening is they typically go through an investment banking company. Like Goldman Sachs is one of the more famous ones, probably one of the biggest ones.
You ever wondered what investment bankers do? Like I did for a really long time. Why do they have so much money? What do they do? They're facilitating these transactions and they're earning money on what's called the spread, like a little commission, the spread.
You get little cuts. Just a little smidge.
A little smidge of a lot.
They're not waiting with tellers for the companies to walk in and cash their paychecks. That's for sure. So, you know, so the investment bankers will underwrite the offering. They will, you know, cover the costs of getting all the paperwork done with the SEC and all that stuff and all the legal aspects of it. And then they will determine what the share price of the IPO is going to be. That is a big risky endeavor because you got to get that right, you know, because you want to make sure that the company gets as much as they can possibly get, but you also don't want it to go on the market and people say, nah, I'm not buying that. That's too high. So you got to get that right. On occasion, there have been some companies that have not gone through investment bankers to go public, like Google is one of the more famous ones, right? And they use a more democratic system called a Dutch auction, where all the people that were going to buy the stock went in and said, here's what we're willing to pay. And they got the average price and then they sold it. And it was all really, it sounded like the great, you know, the cat's meow. The problem was at the end of the day, once the stock started trading on the stock exchanges, the stock popped up 18% that day, and all the insiders realized they just got, you know, shafted out of the 18% because it should have been on their side. They should have made it rather than the people who bought IPO, you know, or the shareholders. So that was considered to be a disaster, and there haven't been too many Dutch auctions, if any, since then. So we're back to investment bankers again. Yeah. So that's how that works.
What about the misnomers about IPOs? Am I actually buying the share as an individual?
Yeah, good question. So you think you're getting an IPO, but the only people that get the IPO price are the ones that are the clients of the investment banking company. So that would be like, you know, your big institutions or your pension plans and things like that. Not Joe average, Joe or Joette average, like Joette, whatever, you know.
Thank you.
We have to end up buying it on after the IPO is done and it starts trading on the stock exchange. So you've probably seen in the morning, this stock started trading today. It's up 60%. Well, that's when you have to buy it, is when it's trading, and you typically don't get a good price. That's a gentle way of saying it. Sometimes if you're buying that day when the market, when it's just going going public, you have no idea what you're paying. People are just, I want to buy a market order. I'll get it, whatever it's selling for. And they don't know what they're just like buying blind.
It's like, remember the Tickle Me Elmo Christmas? It's like that.
Yeah,
everyone's at the store pushing each other. If there was a physical store, you'd be pushing and punching and you say, I'll give you $20 more. I'll give you $20 more. Right.
And the frenzy feels good, like you're getting into something, but what you're getting into is a guaranteed loss almost.
Pretty much.
Because you are not going to make money when you're doing that. Somebody else is, but not you.
Yeah.
You know, so that's the downside, the emotionality of that event. You're not getting in on the ground floor. You actually are getting into something else.
Yeah.
Like almost a guaranteed loss. Right. Right. Yeah.
You know, so the reason that the little guys lose out is twofold usually. So first, as Richard just said, you have the emotional investing. But once the frenzy starts, especially about companies that were really hyped up, like Snowflake here in the Bay Area went public, and everybody had a I know, right? It's funny they didn't change their company name.
Become a pejorative word.
Political stuff around it. But anyway, it's a data technology company. And because a lot of people in the Bay Area work there, or they went out and told all their friends about it, and they created this buzz, and it became sort of a frenzy. And so it's all the people thinking that they're getting it on the ground floor with their Tickle Me Elmo mentality, going out and driving that price up. So it's partially the emotional trading that happens in that first few hours usually. And then also you have the IPO lockup rule, otherwise known as Rule 144.
There's a test after this.
What
rule is it?
I didn't just check my notes. Okay, company insiders and others who acquire the stock in the IPO are prevented from selling it for anywhere from like 90 days to a year. It's usually about 6 months. And the reason for this rule is to prevent the large owners of the IPO from riding the stock up on the initial frenzy and then dumping it. Because that would be a really great way to make money in the stock market, right? Get in before, you and me get to go on the market and buy it and then dump it once we drive the price up.
Right.
That would be fantastic.
But it's very manipulative and
it's illegal.
Bad for the markets in general.
So,
right.
And here's the thing. History has shown that on average, IPOs are down a year later from the date of the initial offering. So if you're watching this on a screen, you can see a chart now. And on the right-hand side of the chart, you're seeing in blue the average losses for all of the IPOs that have come out in the last year. They're down between 37 and 45%. Now, the markets overall are down 21 to 29%. So if you had purchased an IPO, you've probably lost money, and you would have been better off just sitting in a Vanguard S&P 500 free fund, right? I mean, these things just do not pay off over the long run.
Right. But they are sexy.
Oh, they're so fun.
They're so sexy. I got in on the IPO price, and all that. But sexy does not equal making money, right?
No, I'm sorry. I mean, if you've been listening to us for a while, you've heard us say that prudent investing is really boring.
Yeah. It's like watching corn grow. It's boring.
It is. And so, a lot of our clients have what we call the mad money account, where they've picked an amount that they're willing to lose, because this is really fun, right? Yeah. It's almost like going
until
to
you buy it and you find out you lost everything.
Yeah. So, you have your mad money fund, and you pick an amount you're willing to lose, and you have a good time with it. And that's how you scratch the itch of wanting to do the really sexy or sophisticated investment, while also making sure that your, assets and income are actually secure for the future. Yeah.
So in general, when it comes to IPOs, all the hype and hoopla that surrounds, a company going public is really just hot air. It translates into hot air and lost profits for those of us who are left holding the bag and trying to buy it on the IPO day. If you find yourself clamoring to buy something at any price, stop and say, "Oh, wait a minute, I should know better. This is not good. I am not going down I'm going down a rabbit hole that's not going to be good for me." Mm-hmm. It's far better to wait for sanity to return to the markets. And trust me, sanity will return to the IPO, when a stock that's IPOing in a few months or weeks. It'll be sane. There'll be plenty of opportunities to buy it at potentially lower prices, most likely lower prices, right?
As you've seen in the last year. Yeah. And it's still, so this isn't to say, don't buy any new company that comes out. Don't buy individual stocks. Just wait a little.
Just be patient. You'll always get a better opportunity to buy something. Nothing is that, running. We're going to lose.
It's not going to expire.
Not like the girl or the guy that got away, right? It's not like that. You can always buy it. They're trading constantly. Okay. So let's cover some of the common beliefs that are out there about IPOs, shall we?
Let's do it. Yeah, right. We get asked these questions a lot.
Yep. So the first one is, if the public is excited about an IPO, I should invest.
Thinking about trusting the public.
Whatever the public does, folks, do the opposite. That's all I can tell you. Right?
So obviously this is a myth. If the level of public excitement is a bad filter to use for stock selection, a well-liked or well-known company can still be a bad investment. And you shouldn't invest in an IPO just because the company is garnering positive attention. This is called buying the marketing, not the profits. And it's one of the biggest reasons that individual investors fail in general. Yep.
And extreme valuations, like we've been talking about, probably imply that the risk is too high and the reward of the investment at that price is not going to be favorable for you at that level. Also, investors should really keep in mind that a company issuing an IPO has no track record as a publicly traded company. So yes, they've been in business for a while, but they're still they're like a wobbly little horse baby that gets born, a colt. They're kind of like this, trying to get their sea legs. That's what an IPO company's like. They haven't been tested. you don't know how they're going to react to all the things that come at them that are out of their control. So it's early and it's super risky, and you're paying a ridiculous price for it.
And this happens all the time around the excitement. I won't say who, but a member of my family bought.
Oh, come on.
No, we're not going to throw anyone under the bus. No.
Okay, all right.
Okay, this is a great example. Remember Leapfrog, the educational learning tools, right? It was sort of like they had these pretend laptops and we're going to teach your kids things, while they're playing. What a phenomenal idea. Like learning toys were just coming out. This is like early 2000s, late 90s. And so, my family members like, I love this company. We're going to buy the stock. Not one time did we open up a financial statement and take a look at the company. I was like, okay, cool, buy it. Well, naturally, a year later, as my family member says, the frogs were leaping off the Empire State Building. And I think that this person still holds the stock because, long-term investing.
And your equity. I mean, a little thing came along called iPads, and
exactly.
iPhones and stuff that just put that whole technology out of business.
And, in the end, the idea was great, but the kids didn't like the toys.
Is that what happened?
My kids have some of these toys and they're not great. So this is just a personal story about how this can happen, but it's really easy to get caught up in all of the hype.
Okay. So the next common belief is that IPO investments will yield higher rewards than waiting to invest. That is a misunderstanding. It's not exactly an outright falsehood, but it is a misunderstanding. Newly minted companies that are going IPO should be thought of as armed and extremely dangerous in the investment world. They are high risk. They are volatile because they don't have earnings yet to support their prices. And so it's all based on the future. And, the markets can go through times like right now when interest rates are going up. You've seen technology companies, especially, which are a lot of IPOs, just get slammed because all the earnings are in the future. They're way down the road. They're anticipated, but they're not here right now. So it's very hard to price those kinds of companies. So when you look at some of those companies like we talked about with DWAG, Beyond Meat, Allbirds getting slammed, the fact is that some IPOs do flourish, but other ones fail. They just fail miserably. They never get to be great companies.
And again, that doesn't mean that Allbirds necessarily is a bad investment. I don't know. We're not calling it on Allbirds.
No, I'm not calling. I'm just saying it's probably Allbirds is like $2 a share right now. And I think it came out at 25.
Yeah.
So it's probably worth $2 a share. If you bought it today, it's probably a fine investment, but it wasn't when you paid 10 times that price for it without earnings. Yeah. So
the excitement toll
for sure. Yeah. The sexiness is really very hard. It's a big pull. So, we all remember stories of our neighbors who made a killing in the 1990s, the .com era, buying all these different pet stores online. I mean, oh my gosh. What was that one? Pet food. Some of them it was like pets.com or something. Failed misery. There was also a delivery service that was bringing food to your houses, and Safeway is doing it now successfully. And so is Amazon. But that initial one, they had all their trucks and everything, boom, went broke, So these companies that are coming out tend to trade at really high nosebleed prices, to put it mildly. And like I said, when the markets get tough, which they always do, you can bet on the facts that the markets are going to get tough. Those companies will get slaughtered the worst.
Yeah.
As we've just shown you, good information on. Yeah.
Next myth is that if a company is going public, it must be financially stable.
Of course.
Right? It's gone through all the regulations.
Everybody's vetted it, right?
Okay. It's not that simple. It is true that IPOs have audited financials. They've gone through some rigorous reporting and an approval process by the Securities and Exchange Commission. But the future stability and predictability of the financials is uncertain. And that's what Richard was just talking about. Maybe we run into an economic slowdown or another supply chain issue or a pandemic. Right. Who would have thought, right?
Right.
And so the company's fortunes and your fortune, if you're investing in it, are often tied to factors outside of your control once they've gone public. And that's, the pace of global growth, tariffs, government regulations, where we are in the economic cycle, which is totally normal, but could cause you to lose money.
Right.
All of these things.
Competition that you didn't even see coming, right?
Yeah.
So, the SEC, they kick the tires of these companies, but they're not doing a, severe, really detailed check.
Well, they're not doing a forecast against future,
right. Exactly.
All of the future scenarios that could happen. Like when you come in our office and we do a financial plan, we look at all of the possible futures that we can, right? And then we pick a path. Well, the SEC is not doing that with a company.
Not their job.
Right.
Right. Okay, the next one is only individual investors are allowed to buy IPO shares. False. That is flat out false.
Okay.
Well, if you're friends with Jeff Bezos or Mark Zuckerberg, you could have been in on that and gotten some shares on the IPO price, potentially, under the friends and family, clause. But, everybody else, if you're not an institutional investor, you ain't getting the stock. There's just no way you're getting it. And the reason it makes sense, actually, from the underwriter's perspective, the Goldman Sachs of the world, they want to give the stock to companies that are big and liquid and have a lot of money, so they don't have to sell the stock. They want to hold them for the long run. They're not going to be tempted to sell, on the first day because they want to make a quick buck. That's not in anybody's interest to do that. So, if individual investors, no. You're not getting it on the ground floor. You're getting it on the third floor, maybe, right?
That leads us into our next myth is that, IPO investing does get me in on the ground floor. And no, because by the time the shares are available to you through your brokerage account at E-Trade, you're actually buying them on the secondary market. You're not purchasing them from the company directly, which I think is what a lot of people think.
Yep.
So now you're paying fair market price. By 6:35 a.m. our time here on the West Coast. The markets have been open and the stock price is doing its thing, and you're not on the ground. You're not at the IPO price. You're paying market price, which, so the way that this works, if you don't know, is you're on your computer, you submit the order. Okay, go buy it. Your broker dealer, E-Trade, for example, then goes out to the market and it finds somebody willing to sell that share to you. Most likely some institution that bought it 5 minutes ago and now they're making a nice profit on it. And so in that span of time, a stock price can jump a lot. And by the time the deal closes on your end, you might, the stock price might be up $100 a share.
You just have no idea.
I've actually seen this happen for clients that insist we buy IPOs for them on IPO day. I say, okay, it's $60 a share as I'm submitting this order. And then boom, 2 minutes later, it comes back. You're at 120 a share.
And they get really frustrated because they're seeing in the press, the stock's coming out at $35, and they think they're going to get that if they get in right at the beginning of the morning.
Yes.
So when we finally tell them you got it for 60, they think we were sleeping through it or something, but that's the market just opened and that's the opening price that you could buy.
Right.
It's just how it goes. We don't have any control over that.
Yeah.
So our best advice for if you're a potential IPO investor, if you still want to do it after what we've told you, all the pitfalls and horror stories, it's caveat emptor. Let the buyer beware. There are so many unknowns about companies, the company, the industry, the market, what's going to happen, the economy. All these things are unknown. Most of them are out of the company's control. And so, it just, you really don't have enough information to buy the company and know what a fair price is, right? So not all IPOs are created equal also. Ideally, companies with competitive advantages will do well in the market in the future. But, like we said, the vast majority of companies that go IPO, they enrich the people that are selling the shares and at the expense of the people who are buying them.
Yeah.
So the IPOs are actually better suited for long-term investors who have a high risk tolerance, who can afford to see the thing vaporize.
Yeah.
Really. It's just part of their strategy.
Right.
Because sometimes you can make it, it's like having a good spice, in your meal. Sometimes it makes it really well. Other times it kills you.
Other times you put too much cumin in.
Too much cumin or whatever. It kills the whole recipe. Yeah. Right.
So, not a hard and fast rule, but wait 6 months. Just wait a couple months and see what happens.
Right.
Because if I understand the urge to, Google's coming out. Like Google's a great example. Had you bought on the day, you're fine
worked out great.
Today, right? Yeah. But it also would have worked out great had you bought it 6 months later, because it's a great company who has continued to improve and their share price has continued to go up. So if it's really a great company, waiting the 6 months, maybe you make 5% less, or maybe you don't lose 60%.
Right.
That's the more likely scenario.
Good point.
If you wait. And then also, I think paying attention to fundamental analysis, like getting back to basics. Maybe we'll do a future show on like qualitative analysis of a stock.
Right.
But quantitative, did I just say qualitative? Quantitative analysis of a stock. Because again, do not let yourself get subjected to, you know, the tulip frenzy of it all, or to the marketing. You're not buying the marketing, you're buying the profitability, and you need to look at that.
Right. Speaking of that, the situation going on with IPOs is indicative. It's a subset of a bigger problem. And that is just what price you actually pay for a company, right? When you buy them. And so just for example, right now you can buy Amazon for a price earnings ratio of 88 times. So you pay $88 for $1 of earnings. Basically, that's the way that you're paying 88 times. Amazon is a retailer, right? They happen to sell their stuff online. But another retailer is Target, and Target is not selling
Target.
Target, yeah. It's like not to be confused with J.C. Penney, that French store. But Target is selling at 18 times earnings. So it's basically selling at 1/4 of the price, the valuation of Amazon. Is Amazon really worth 4 times more, you know, in terms of earnings? Right. It's like if you were going to buy,
so, but
you know, I often compare them like if you had like 2 Foster Freezes downtown in Danville. We have Foster Freeze in Danville, very few of them. And one of them is selling at like 100 times, you have to pay $100, 100 times whatever the earnings are, and the other one's at 10. Which one are you going to invest in?
Right.
You're going to buy the one that's cheaper, right? They both do the same thing. They make it really is smart to do that, but people just do not. They want to jump into Tesla and all these things that are selling
because they're darling.
I know, but it's just they don't understand. Slow. The tortoise makes the money, really. Yeah. It's very hard to emotionally take.
Well, that's boring.
I know, but that's how it goes, folks. You want to get into that crazy game, you're going to end up with a crazy result. Yeah.
Well, okay. So future episode on stock analysis and PE ratios. We'll teach you everything you never wanted to know about that.
And then some.
Just like we did with IPOs. If you have, we hope that this has been informative. If you have any questions about IPOs, please don't hesitate to reach out, or for that matter, questions on anything related to finances, or maybe you have a topic request for us. Please feel free to send it to us. We're at, like 30. This is episode 30. So we're going to start needing some ideas soon. We're going to run out. And if you would like to schedule a meeting with us to consult on your own finances, you can click on the link in the show notes, or you can go to our website. We're also offering an electronic copy of the book, The Investment Answer. If you want to know more about our approach to investing, we encourage you to download a copy. It's very easy to read. You can do it in an evening. It's one of our favorite books. It has the potential to revolutionize your relationship to investing and help you avoid many, if not all, of the mistakes that you may be making without even knowing it.
That's right. And I really encourage you to go on there and download it, because it is really fabulous. You know, you will not suffer from a lot of the misunderstandings and wrong interpretations of what you see in the marketplace and what you see in the press if you just read the book. A couple hours, right? That's all it takes.
And we've got a lot of cocktail parties coming up with the holidays. So if you want to sound super smart, like you know what you're talking about, just read a few pages of that book before you
smart but not sexy. But you'll know better, right? Yeah.
Well, that's a wrap. We are skipping our episode in 2 weeks because of the Thanksgiving holiday. We hope everybody has a wonderful time with their loved ones, whoever they choose to spend it with. Happy Thanksgiving to you. We'll see you 2 weeks after that.
Yeah. And don't fight about politics with your family members, okay? So remember, you're invested and so are we. Take care. We'll see you soon.
Bye, everyone.